Yes, you can get a mortgage today in 2023 at 3%. It's not clickbait. It's called assumption of mortgage. Hi, I'm Daniel Fischpan with Fischpan Mortgage. Let's get right into it. Now, my realtor friends, my investors, my veterans, stay with me to the end. I have some important information for you guys. So an assumption of mortgage is when you basically take over someone else's mortgage. You find a house that you want to buy, and you know that the seller, or you find out that the seller has a 3% mortgage rate. And you said, you know what? How about I take that mortgage over, absolve you of all the liability for the mortgage. The lender knows that I'm now responsible. You walk away, I get a 3% mortgage, and we all win. That is assumption of mortgage. Now, is there nuance? Yes. Are there some stipulations? You better believe it. The first thing to know is which loans are assumable and which ones aren't. So government loans are like FHA, VA, USDA. In some cases, even adjustable rate mortgages are assumable. Most conventional mortgages are not assumable. So let's go through an example to see what does that look like. So let's say you want to buy a home from someone, and that seller at the time bought their house for $500,000. They put down 10%, so the loan amount was $450,000. The rate is 3%. And after 5 years, now the seller wants to sell their house. Well, let's talk about what happened in those 5 years. They paid down the principal. So let's say their new loan amount, current loan amount, is $415,000. And in those 5 years, especially if you're in the Scottsdale area, your house appreciated significantly. Let's say $250,000. And so now the seller is selling their house for $750,000. They still have a loan amount of $415,000. It's all fine and dandy that you want to assume their mortgage for $415,000. Where are you going to get the $335,000 to put down to buy the house? And that's the first issue. A lot of people do not have that huge cash down payment to cover the rest of the purchase of the property. That's the major hurdle. But you also have to qualify for the mortgage. So you're going to go to the servicer that the seller is using. You're going to have to talk to them, give them documentation, and qualify for their mortgage. So you're now going to assume $415,000. The purchase price is $750,000. Let's say you put down 10% or $75,000. You're still left with an outstanding balance of $260,000. So where is that money going to come from? Well, it could come from one of three places. Number one, you could get a piggyback HELOC, a home equity line of credit, and now have those two payments. Now that HELOC could be 9, 10, 11, 12%. You can also get a fixed second mortgage, which could also be 9, 10, 11, 12%. While that's very high, the blended rate between the 3% mortgage and the, let's say, 11% mortgage could still potentially be lower than current mortgage rates today, around 7.5%. The third option is you may be able to get a hard money loan. So let's actually run through an example and see what the numbers look like. So here we are looking at a blended rate calculator, putting in $415,000 at 3% and $260,000 at 11%, and that spits out a blended rate of 6.081%, making the principal and interest payment $4,082. Now, if you were to take out a loan for $675,000 at 7.5%, which is kind of what rates are today, that monthly payment is $4,720. That's a monthly savings of $638 on your mortgage payment. Now, granted, you still have to pay the FHA mortgage insurance, but it's still a ton of savings in there. Okay, realtor friends, next time you're on the MLS, go to Quick Search, scroll down to the bottom to add a field, and type in the word loan. There you're going to see existing first loan. Go ahead and select FHA, VA, and you can get out of it. Now, what you see on the map are every property on your MLS that's currently for sale that has an assumable mortgage. Now, the seller may not be interested in letting someone assume their mortgage, but now you have identified where are the properties that can be assumed. All right, investors, your turn. When it comes time to buy a property, if you were to take out a loan, you cannot take out an FHA loan. One of the stipulations with an FHA loan is that it's for a primary residence. However, when it comes to an assumption of mortgage, You can be a non-owner occupied, which means that you, as an investor, can buy a property at 3%, and now your cap rates and now your cash on cash looks a lot better. The minor stipulation there is that you have to put down 25% of the purchase price, but let's be honest, if you were going to get a loan, you would still put down 20% anyway. All right, now to my veterans. First and foremost, thank you for your service. Thank you. You have something called entitlement. That means that you can get a VA loan and not put any money down. The entitlement amount is related to the max conventional loan amount, which today in 2023 is $726,200. Now, if you let your VA loan get assumed, and let's say you have $300,000 still outstanding, you can still get a secondary VA loan, but your entitlement amount is no longer $726,200. It's $726,200 minus the $300,000. So if you were to take out a loan for $500,000, every dollar above the $426,200, you will be required to put down 25%. Guys, thank you so much. I hope there was a lot of value here for you guys. I'd appreciate a like, a subscribe. Let's grow this channel. I'm excited. Are you excited? Mwah, 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 mwah. Next topic is going to be about shopping for a mortgage, right? You never hear mortgage people talk about how you should shop for a mortgage, but I'm here to help. Let's figure out if you're really being taken advantage of or if you're getting a good deal, and how to truly shop rates and compare apples to apples. Guys, thank you so much. Subscribe.